Stocks finished the week on a pretty sour note, down about over 5.25 or nearly 5.25% in the last 2 days alone. So I'm going to break down just how significant that move was, and what kind of, like when we've seen this before, what kind of market that's been, especially in terms of volatility, and why now this 2-day drop, it doesn't seem nearly as significant or as capitulative as we've seen in the past, to the point where it actually might be more signaling the beginning of a bigger move, at least a new leg to the downside. So we're going to break all that down in today's chart and kind of see again the rolling over that we've been looking at for the last couple of weeks or so, or at least last week, as we've been kind of holding resistance with these really small ranges. We talked about the expectation that we would be going to a new leg to the downside, and that's obviously nobody knew it occur in 2 days at 5% clip. But the type of environment that this move has created, and certainly set us up for this kind of a move, not knowing the extent. So we're going to break down now what do we expect going forward, especially with big week next week with the FOMC and options expiration. What should we expect to see going into next week? What should we see coming out of next week going into a July expiration? We're going to break that down. What's big moves in different asset classes, some kind of head-scratching moves in different asset classes. So we'll break that down as well with our trade idea as usual. So let's go ahead and get started. Today is Friday, June 10th, 2022. This is the market outlook from MarketScholars.com. My name is David Settle. All right, before we get started really quick, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. Click that thumbs up icon down below. Comment on the video. Join our website at MarketScholars.com. There's a link popping out up there in the top right corner of your screen. Click on that. Follow me on Twitter for more content between the videos. There's my handle at DavidSettle42, and join our Market Outlook Facebook group that we've created. Also, if you're watching us here on our blog, come down here, click on that heart. It takes you to this tab. Hit that like button. Same thing here. Click the thumbs up icon. Like us on Facebook as well. That helps us out a lot. It gets our content out to more of our followers. So that's why we always ask, and we really appreciate those that do like us on those platforms. All right, well, let's take a look at the S&P 500 with the market forecast indicator. We are back to dark pink shading and a red line after pretty extended period without one. And we never did get dark green shading and a green line. We did over here in March, and then again for a couple of days in April, but we never did get the green line here. We never got the 30-day moving average rising. And just like that, yesterday we broke down below the orange 23% retracement level of this longer term decline. Today we broke down below the green one of this current intermediate decline. So the retracement that we've been on is done according to those, especially considering that we're about 100 points below that. So that's a pretty significant break. Short-term sentiment dropped like a rock down to extreme lows for both the momentum and the near-term line. In fact, it looks like over there in the top left that over here where my cursor is, you can see that the momentum line got to a quarter of a point, and the near-term line got to a third of a point. So both below a half a point. That's about as low as you can possibly get. The intermediate line just barely crossed below 50. It's actually still in neutral territory. It kind of goes to show, among other things, that, boy, this doesn't seem like it's done at all. We did drop also easily. Like yesterday, we got to 1.25% below the moving average. Today, we're down nearly 4% below. So remember, we talked about getting 2.5% below is a pretty significant break below the moving average, and that's, needless to say, right? Things have gotten pretty bearish on the S&P. We're 5% below on the NASDAQ, easily breaking same pattern, almost back in bearish territory for the intermediate line. The Russell 2000, it actually got into bullish territory. You actually did get 1 day of dark green shading in the green line, but again, below both the 23% retracement levels, though not as significantly below that we saw. And it actually did get above the 38% retracement. And you can see back below that 38% retracement of the post-COVID rally as well. If you look at the NASDAQ, when you're looking at that 38% line, that's actually, we never did get above it. And then SPX, we're still not below it yet. So there's that 38%, there's the 23%. So these two lines right here, that we're still above on the S&P. We are actually there. Here's those two lines on the NASDAQ. We're actually well below it. And then here's those two lines on the Russell 2000. We're actually below both of them, having gotten back below the 38% here the last couple of days. So it kind of goes to show where the S&P is expected to go, right? We are expecting it to get below those same two lines because it already has on the Russell and on the S&P. And the Russell, again, very bearish short-term sentiment. Market sentiment's really low, and this is a really bearish intermediate peak if that's all we get. Just like these others are. I mean, for the intermediate line not even get in the bullish territory is a pretty bearish peak there. And again, you expect that we will head over. If you look at like the whole moving average, we've been looking at that for signs of reversal. But we got 2 of the 3 yesterday, and we got the third one today. Right at the open, we got the parabolic SAR flipping up to the top. So we got all 3 signs here that we are rolling over to the downside. When you look at like the McClellan oscillator, you can see it's rolling back over too. So we're back to a negative on the below 0 on the McClellan oscillator. You can see you kind of fluctuate, but when you've been bullish like this and you get negative, that's kind of the sign that we roll back down. Again, kind of bullish up in this area. During this little rally, we got a little bullish, but I mean, we were pretty bullish there. We got above 100, which is pretty crazy, but we got above 100 there. So we've had some pretty bullish periods and now easily negative. Like, in fact, if you look at the new highs, new lows index that's been updated here, it dropped to 695. It's just updated now, up to 695, well below 300, which is kind of the level that you start to look for it to break down, right? About 300, as you can see, there's been instances where you're kind of right around this 250 to 300 level. Some other periods of brief pullbacks. Well, 700 is easily below that, and we are also easily below that moving average. This is kind of the same thing as what the McClellan oscillator looks at, well below the moving average. I mean, that's pretty bearish all across the board. What you really don't see quite yet is a big drop in the skew, right? The skew, like usually when we tank, the skew tanks to really low levels. I mean, even just on this intermediate pullback, we got below 118. But if you look at, again, some other instances here of when we've been really, really bearish, like in COVID, it got down below 115. And in the fourth quarter 2018, it got down to below 115, 112 and a half. In 15 and 16, we got to low levels. And we're still at 121. And so it's still, really like not showing the same kind of just extreme bearishness. If I were to look at the weekly moving average for the skew, it's still at 131. You can see where it got to with COVID. They're down below 130. It really got low eventually with the fourth quarter 2018, and then you can see 15 and 16. Like we're still up. We're still relatively high here. And when you look at this on a log scale chart, and it's not really a log scale, but let's see, where's that log scale? There, it kind of is. It doesn't look so bearish when you look at it in perspective of the move that we've been on. Remember, it has not broken the 23% retracement of this big rally we've been on. It actually broke the 23 and the 38 with the COVID drop. It has not broken that with this drop. So it kind of goes to show some perspective on this bearishness. But we are obviously easily bearish now. I mean, and the summation is clearly rolling over here. So we are on a downside move. Needless to say, right? When you look at the weekly version of the market forecast, after getting the near-term line up into the upper reversal zone, into bullish territory and in the upper reversal zone, right back out of it with a bearish market sentiment or momentum line, intermediate line still oversold in the lower reversal zone. Market sentiment is still in bullish territory, so it hasn't really dropped yet. But remember, market sentiment doesn't drop out of bullish territory for corrections. It only drops this long-term line here. You can see during COVID it didn't drop. During fourth quarter 2018 it barely dropped. The intermediate line got to the reversal zone, just barely there. In 15 and 16 it just barely dropped below that. Definitely did not get into the lower half of the chart. Same thing in 2011. The intermediate line didn't get to the reversal zone. So the market sentiment line really doesn't break down until you get into like the correction that leads to the bear market, right? Which is, again, there's some expectation that's where we're headed to right now. The correction that will lead to a bear market as we're still in the green line. You can see the weekly chart, dark pink shading and the red line still on the S&P 500. When you look at, let's look at the other weekly chart for the S&P. The PPO is down -4%. And the Hakinyashi candle is back to a neutral candle. So we had one bullish week, but not as bullish, right? We didn't close up above the previous high point there, even though we didn't get a lower shadow. But we're back to a transition, so not really a bullish trend going on there. You don't see that on the NASDAQ either, and you don't see it on the Russell, right? The Russell, even more of a transition because a really small body there. So, trying to be bullish, but just can't do it, right? It hasn't been able to really take hold there. When you look at some of these other indicators, remember how we were so low on both of these, like barely above 20? Well, in 2 days that's changed. We're well above 30 in the negative. We're well below 20. In fact, we're almost below 15 on the positive indicator. That is breakout mode on the DMI. And the ADX is about to rise up above 20. Breakout mode there. When you look at some of these other oscillators, the RSI and the CCI, you're broke below 40. You broke back below -100. So you're back in bearish territories there. The Bollinger Bands, you broke into the lowest quartile of the Bollinger Bandwidth. And you remember when you look at that with the Keltner channels, the bandwidth had actually come inside the Keltner channels, still are inside of it. And so you're setting up, and the momentum was bullish. Now you're setting up for, a bearish, for the green dots to come on as we move from bullish to bearish. So we're, setting up for pushing a new trending move lower to the downside. Again, we had ended the bearish trend with this rally, and we're still not in the bearish trend. We tried to go positive, but that's gone now, and now it's a matter of potentially again, we, as bearish as this is, we still haven't begun the bearish leg. What's interesting too is this is kind of what stands out to me is really significant. When you look at this 2-day rate of change, so we've been down these 2 days in a row. And really, 3 days, right? If I were to put on that third day, it's it's been a pretty bearish day, but we've had some 3-day moves in the past. So let's just stick with the 2 days because that's we had the breakdown yesterday and then the confirmation today. I mean, you can see how bearish that is, and you can see how rare it is to get this bearish. The last time we were this bearish, when we had this big of a drop, we were not. Like it was February the 25th, I believe. Yeah, February the 25th was the last time we had this big of a drop in 2 days. Well, let me show you a few things about that February the 25th. First of all, it produced we're not producing a new 4-week low point. We're not like down to new lows. A lot of these big 5-6% drops usually set the low because they've gone down from a peak. And we've already been going down. They set the low point. Well, if you look at like the Arun indicator, which measures where the 4-week high and 4-week low point are, you can see in February 25th, right here, 2 days after options expiration, we had spiked up to 100 on the negative indicator. The positive was rolling down. Well, the positive's already down, but we don't have a spike on the negative indicator. The other thing that stands out too is the VIX 3M ratio, right? When I look at this ratio, then you can see on February the 25th, so right there, we were at 27.85. Well, we closed today at 27.75. Very similar move on the VIX on an absolute basis, but not on the VIX 3M. If you look down there at the bottom, here on February the 25th, right here, right there, there's where we close, right where my cursor is, at 116%. Well, if you look at where if you look at where we're at now, 116% is right up here, and look at where the VIX is relative to the VIX 3M. On the same day, that we get this 2-day drop of nearly 6%, right? So volatility is really low. And if you look at the volatility of the VIX, so the VVIX, again, going back to that same, we were below 100 and we spiked up on 225. We had spiked up well above 100 and we got up to 121.01, right? So, but here, so here's 121.01 right in this area where my cursor is. So that's where we're at now. We're not even above 100. So the VIX, between the VIX ratio at the bottom and the VVIX here, on a day like today where you get a significant drop to the downside, that usually either sets the low point or you're in capitulation mode, and the volatility index is telling you we are hardly in a capitulation mode. In fact, we're still very complacent, despite the fact that we just dropped 5% in 2 days. Looking at the ATR, we're at 2.5%. Again, for the VIX to be this low, especially relative to the VIX 3M, with the ATR 2.5% of the current price is tremendously high. And with this, and not only that, but if you saw that the historical volatility is rising and implied volatility is rising, it is uncommon, very uncommon, for both to be rising with the historical still above implied. Usually when the historical is above implied, they're both falling, right? They're all both falling here. But that's not the case right now. Instead, they're actually both rising with these two. Dietrich said that this is the first time since 2020 that we've had 3 consecutive 1% days. Though we did have over here, I mean, we were down this is on SPY. On SPY, we did have 4 days in a row. I think we were only 0.96 on SPX. So SPY, we did get the 1% drop. So that's why I'm not reading too much into that one, because we've had other 1% declines. I mean, today I would actually count as a 3% decline because of the 3% decline because of the, we were at what, 2.9 today on SPY. So needless to say, the type of move we're getting right now is setting us up for more of an extended decline. And in my opinion, we might be finally headed towards the decline that takes us to our correction low point, which will be at least at this 350 in my opinion, which is only 10% drop from here. If not eventually down towards this red and black line, the 38 and 62, which, if you can see, I think that's where IWM is headed, towards this 38 to 62% retracement level into this area with that point of control. So I believe we will go below. You can see the same level for the Qs, the 38 and 62 right on top of each other. That's actually at the 200 week. So NASDAQ might actually go a little bit further down to its 50 and 78. That's a 25% decline if it gets down into that area, because there's no volume there. If it gets to these levels and breaks that support, there's nothing to hold it up. I think that's where the correction lows will probably get through the 200-week moving average this go around, and before climbing back up on the correction bounce to see whether we get back above the 50 and 30, which are going to be way high. Which again, is my opinion, is a reason why for me to expect that this correction will probably lead us towards a bear market eventually. But next week you got FOMC, so the first couple of days are probably going to be pretty sideways, especially after such a big 2-day move. You'll consolidate some of it. The market could very well knee-jerk coming out of FOMC to the upside like it has been doing. But then after that, the trend is pretty much set in for a leg lower right now to the downside. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below. There's the link there. Let me know in the comment section below what you think. If you think that if you're more bullish than I am or more bearish than I am, tell us why. What charts or indicators are you looking at that would suggest why you're that way? And then let me know what you think about our conclusions that we've come up with here with our technical analysis. All right, let's take a look at what's driving this price action here. And obviously it's very inflation related, and you can actually see yields are up, bonds are actually down. As big of a drop that we've had in these risk asset classes. Gold rallied here today, but though not yesterday. The dollar rallied and yields, the bonds stayed down. And commodities only dropped a little bit. If we take a look at just this last 5 days, let me show you the 5 days by themselves on an intraday basis. And you can see where most of the declines occurred. And again, in the last couple of days, down 5% for the week. We went into Friday just barely up a little bit. Commodities were up. Emerging markets were up. They actually outperformed. International developed markets dropped like a rock. They were down 7%. The Q's down 6%. You can see IWM holding ground pretty well. High yield corporate debt was down 4% on the week. Again, bonds were down 2%, and gold and commodities and the dollar all rallied, which again, typically don't expect commodities to be in mind. You expect bonds to be up there, not commodities. So it kind of goes to show what kind of market we're in right now. When you look at, like, let's take a look here at the US dollar, especially against the yen. Remember, that's the main one we've been looking at here lately. You can see the long lower shadows we've been getting the last couple of days. The MACD histogram is rolling over. Remember, the histogram peaks first, and then the MACD itself peaks, the blue line down there. We had gone through the 0% level up to new highs. And the question is whether or not that's going to end up being a divergent high point, as parabolic as we've gone. And again, the long lower shadows, it's more bearish to have long upper shadows, kind of like this one here, or this one, relatively this one there. But long lower shadows can be bearish too. So you can see the dollar and how it's performing against the yen. Here's the dollar against the franc. It had really taken off the 50-day moving average back up to the upside, and it rallied sharply today, unlike against the yen. So it kind of goes to show, again, these are your two safe haven asset classes. When you look at it against the Canadian dollar, which is really its biggest trading partner, the biggest component of the trade-weighted US dollar, you can see there's not nearly as much of a trend. But in 2 days, the value of the dollar has gone up quite a bit and pretty much regained more than a week's worth of losses, getting back above that 78%. Let me zoom out so you can see that those Fibonacci lines here. So there's the 0%. So we had retraced more than 100%, but kind of a fake out there below those lows. And now we're trying to get back above that 78% of this bullish move. So it's interesting how bullish the dollar's been, but it has not been that bullish against the Canadian dollar. It's actually been relatively bearish. In fact, it's in a bear market mode because of the weekly chart. So you're below the 200-week moving average, and so is all these other moving averages, even if they've been gradually rising since the end of last year. But unable to get above the 78% retracement and then stay there, right? And without falling back down, of course, there'll be some resistance up in that area. So needless to say, the dollar's been doing really well, especially against European currencies, but not necessarily too well against like the yen or the Canadian dollar. So it kind of puts the dollar move in perspective when we talk about how bullish the dollar's been. Yields bonds have basically just been retracing the lows that we had in early May, coming down into these lows. If you look at the 10-year note itself, it's close to, but it actually does have the higher closing high point. The high here is 31.67, so we're still just a smidgen below that. We did get a higher high point today. It's a pretty significant move. And when you look at what these yields have gone to, so there's your 2-year yield at over 3%, and this is getting relatively recent for us to get this kind of a move. We had been below 2.75% until the last couple of days. And then we really spiked up to this 3% level. The 10-year note, if you take a look at the 10-year note, it was already at the 3% mark. It was already at the 3% mark, just a little bit below that before breaking up to 3.15%. So the spread between the two had been been kind of stagnating in the 20s over the last little bit. You can see the big sideways action we've been having for a while, right around the 25 basis points, between 20 and 40. It's been trading in that range. Well, it broke down below that range for the first time since it went inverted at the end of March, beginning of April, when it got below zero there briefly, and now we're back to 10 basis points. So in other words, what the Fed is saying is, or what the bond market is saying is, you're going to, between 300 and 325 is ultimately where we'll probably end up getting to on this, and the bond market says we actually should be there right now with the yield curve already inverted. The futures market is giving us a really high probability of being, at that by the end of this year at 325 basis points. We basically have a 90% odds of that happening. You have about a 60% odds of it getting up to 325, 350. So high probability. And you can see that 300 to 325 level that we're at right now. If you look at that would be this red line going into today. It was below 40% low probability. Like I mentioned, it's over 60% now. And this line's up to 90. This purple line's up to 90. So these, just a few days ago, May 27th, I guess a few weeks ago, a couple weeks ago, 2 weeks ago, we were sitting at really low probabilities for either one of those. We were kind of stuck at the 250, 275. So the odds for these two rate moves have gone up tremendously in just the past 2 weeks. Most of it here more recently. So the market's pricing in the Fed raising rates. Now the question is going to be, of course, what do they do? What are they going to do at the July meeting, right? The 50 basis points had been baked in 98% a week ago, 96% a day ago. Now it's 76 because the odds of a 75 basis point hike are still low, but they were much lower a week ago. And if you look at the move after this, so if you get the 50 basis points here up to 150, to get up to 200 be another 50 basis points. It's 100% odds that we'll have those 250 hikes. It's a pretty decent odds, about 64% odds that you're going to get a 75 basis point hike in July, at least in June or July, but most likely in July. So the odds of us flipping that script, remember the Fed at their last meeting said 75 basis points was not on the table. Like they said it, they were quoted, he was quoted about that, very specific. In fact, if you recall, we talked about this, that in the March meeting, 50 basis points was off the table, and yet that's ended up what we ended up getting, or what we're widely expected to get in June. So the fact that he says that 75 basis points doesn't mean anything. In fact, I think that's going to be the big factor next week is, how likely are they to actually give us a 75 basis point hike in July when they've already said very specifically that they're going to do 50 in June and July, and then see what happens after that. Let's take a look at how these sectors did here this week. So we'll do the same chart, but with the sectors. We'll go to a comparison chart. And then go out to just this week. And you can see energy was your best performer. It was up for most of the week. It was down today, but still finishing down less than 1%. All your other safe haven areas down 2.5% to 4%. And then your cyclical areas, including financials, is getting really hammered right now. Discretionary, technology, even materials ended up getting beat up here, and a really, really bad day for it. Let's take a look at the 12 grid for all the sector moves. Energy is the one outlier. It's in dark green shading, and the green line, the intermediate line's in the 90th percentile. Everything else is rolling over. Remember, the correction, in my opinion, the correction won't be over until everything drops, right? Even in 2007, 2008, during the correction that ultimately led to the bear market of 2008, when we failed at the moving average in May of 08, and then we really fell off a cliff at that point. So that's when the bear market starts, when you have a correction and then the failed correction bounce. But that correction in that late 2007, that bottomed out in early 2008, energy did not participate in most of that correction until that last month or 2 months. And again, I believe that same thing is happening here. Energy's been very strong. It's a late cycle correction, very similar to 2007. But eventually, like 2008, energy did come down, right? So if I were to, let's see if I can kind of zoom in. Let me go actually to this chart here. And we'll do XLE. And then let's go out to a weekly chart to kind of show you what I'm talking about here. So here's 2007, 2008. You can see the S&P started to correct back over here. You had the pullback and the failed pullback bounce. So you started to correct at the end of December and then into January is when that thing really started to correct. So XLE, you notice, stayed bullish except for all the way up until the very end, till September 2007, January 2007, and it finally came down. It didn't correct. It only came down to its moving average, but it finally came down after the S&P was already bearish. That's how already had its pullback and it failed pullback bounce, and then that's bearish here. So we're seeing a very similar effect here to energy. The market's been in correction mode, but energy's been riding well above its 8-day moving average. It's actually outside of the value area of its 5-year chart and really just chugging higher. Though, again, long upper shadow this week, and you're in somewhat of a convergence mode here, would suggest that this strength might not last too long. And if and when it starts to come down too, it doesn't have to get to the 200-week moving average like the S&P, but just like it did in 2008, if it just comes down to its 50-day moving average, or 30 or 50 in that area, which would be quite the decline, but if it had that kind of a move, then we'll know that, okay, the correction is, now that everything is dropping and participating, the correction is most likely now over at that point. And so far I traded the other day, I wanted to take a look at Caterpillar. Let's start off with the market forecast chart on Caterpillar. It had been pretty strongly bullish, kind of going a little semi-parabolic, near-term divergence with the lower highs, and then a big drop to bearish short-term sentiment. Significant turnaround. You can see we closed below the low of the high day yesterday. We closed back below that 23% retracement level today. You're still more than 1% above the moving average, so it hasn't quite broken down, but there's a reason for that, because when you look at the chart here, you can see there's a heavy layer of volume here. I mean, it's pretty much been a sideways trend all year between the 23 and 62% retracement levels. I mean, a little bit above and below those lines, but for the most part, it's been sideways all year. And you notice it's been sideways to the point where we built up quite the node with the point of control towards the lower end, and we're well above it. So you got the MACD and stochastics are rolling over, the RSI and the CCI are rolling over, heading to bearish levels. Here's Caterpillar, heading towards bearish levels, kind of at neutral levels right now. The Bollinger bandwidth had been pretty big. It's now rolling over. You can see the clearly, and right in the middle of the bandwidth, you can see clearly how big this node is. There's no trend strength. The trend strength has dropped. It's not zero yet, but it's dropped down to very minimal, very weak strength as we're back into the cloud. So this is about as neutral and sideways, especially for a stock that's volatile as it's been, about of a sideways pattern as you can get. So of course, what does that mean? That we do a bear call and a bull put spread together. So we'll do a bull put spread between the 200 and 195, bear call here between 230 and 240, because a $10 wide on this side, $5 wide on the other side, and you can see what it does. It gives you a pretty decent reward for a small amount of risk. Now I ended up doubling up on this because I think I fat fingered it to the upside, but we were going for 2/3 of a normal risk and getting well over the normal $300 reward that we get for a full amount of risk, right? And we're only taking 2/3. So it's a good trade setup, relatively high. You can see those blue lines here are the break-even points. And when you look at the break-even points here, like on the Bollinger bandwidth, for an example, basically they're at the highs, right? The highs of the year, 52-week highs outside the volume node. Down here at the bottom end of the value area here, multiple touches. So very, very wide, very easy to trade between range that we're in on as we head into that July, as we head into June expiration, but they keep going into July expiration for this particular trade. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Remember, you can also like us on Twitter and Facebook as well. Subscribe to our site at marketscholars.com for free. Have a great rest of your weekend, everybody, and we'll see you all next time.